I'm Spencer Noon. I am an investor at GTC Capital. We're here talking about leveraged crypto investing, which is a really fun topic. Before we get in, and I've got a lot of questions here for you guys, maybe you could introduce yourselves though. So let's start with Will.
Sure, thanks. So my name is Will Peets. I'm the founder of 100 Acre Ventures. We're a fund focusing on investing in technology that empowers current markets and new markets. And we run a model-informed trading strategy focused largely on Bitcoin derivatives, and to a lesser extent, liquid alts.
Great. Who's
Hey,
next?
guys.
Sam, do you want to go? Or Will?
Sure.
Or Josh? Sorry.
Go ahead, Josh.
Sure, thanks. So my name is Josh Willem. I work at Genesis Trading, which is a global principal trading firm that provides liquidity across all kinds of crypto assets and across all different product types, including spot derivatives. We're very closely affiliated with Genesis Capital, which is a big lending arm, and quite active with a large number of trading counterparties in the space. And we're also known to be kind of affiliated with Grayscale, which is one of the bigger asset managers in the space as well.
Cool.
Hey, I'm Sam Tribuco. I'm a senior trader at Alameda Research, which is a global quantitative trading firm. We have offices in Berkeley and Hong Kong. We trade hundreds of millions of dollars across every day, across every liquid exchange, across every product, every underlying. We are a large market maker. We run an OTC desk, and we're also known for working with the FTX exchange.
Got it. Awesome. So okay, let's start, because we probably have a lot of people in the audience who really don't know this space whatsoever. So I think we should walk through it at a very high level before we can kind of dive in. So can someone take a stab and just explain what leverage investing is? Give us the 101 on just the kind of landscape at large.
Sure. Yeah. So there's a bunch of like well-known crypto exchanges. Like think BitMEX, Huobi, FTX, OKX, Binance. Those exchanges. Many of them have derivative products and spot products, which you can. Starting from spot. So typically, when you think about trading crypto, you might think about sending in like USD or other fiat and buying crypto with it. With leverage, what you can do is post collateral for some position that lets you enter into a position larger than you would be able to, for instance, just by using that collateral to trade into a position of the same size. Different exchanges let you do different things. Many exchanges let you get up to 100x leverage, which basically means that you can put on a position of size equal to like 100x the collateral you're posting. It's a little more complicated than that, but yeah, basically the gist is that you can post collateral and enter into very large positions sometimes, and you have to do some maintenance, but that's the basic idea.
Got it. So why are people doing this? Who are the players in the space? Is it just kind of retail investors? You obviously have funds like the one that you run, Will. I want to dive more just into the different ecosystem players.
Oh yeah, so I can talk from my perspective. So we're a principal liquidity provider in the space. We talk to a lot of larger institutional and kind of corporate market participants, and so a lot of these guys do want access to spot, or they do want to, they're not really looking to trade the asset class on leverage, but maybe they want to get access to a position very quickly, or they don't deliver cash up front. A lot of kind of OTC trading happens on a post-trade settlement basis, which means cash transfers after an agreed upon price for a trade. So when dealers and kind of OTC liquidity providers need to hedge themselves, they have to go to some of these venues that do offer leverage. And I think for two reasons, right? One is it allows them to kind of protect themselves from price movements, sort of hedge their price exposure without necessarily trading the spot market, which is the underlying market where you pay for cash for the actual asset. And secondly, the liquidity on these derivative markets is much, much deeper, right? If you kind of aggregate all the liquidity across derivative exchanges in sort of the linear products like the perpetual swaps and the futures, and you just compare that to like the kind of spot markets that are out there, it's an order of magnitude bigger, right? Like 10x bigger. So that's another big reason, is just to get off risk quickly and to interact with a larger pool of market participants. It's often necessary to access these leverage exchanges.
Yeah, I would kind of partition the use of leverage into maybe three categories. I think there's retail, and probably to a lesser extent institutional investors who are using leverage to take directional exposure. I think exchanges that are offering 100x leverage, I tend to feel it's more like a retail type use of leverage. I think certainly there's application of leverage in more institutional trading strategies where you're trying to capture some sort of arbitrage opportunity or a basis between spot and futures, and so you'll run a levered portfolio or higher gross and use leverage in that capacity. For us, we sit somewhere in between where we'll use leverage to take directional risk, but we're also using it really to improve capital efficiency across the different venues. So one of the kind of artifacts of crypto trading today that still exists is very fragmented liquidity between different venues. And so if we have our model updates and we have a directional view that we want to put on, but we don't have capital in the right places, we might take increased gross exposure and take leverage so that we can effectively neutralize risk across our entire book, but using two different venues to do it. And I think a third category, which is probably less talked about, is those that are using it more from a operating business perspective and hedging risk they have in the portfolios. That could be a mining company, that could be someone else who, maybe even Genesis to some capacity, where they have a lending business, and so they're using leverage to kind of balance their book and hedge risk. And so there's a growing number of businesses that I think have crypto on their balance sheet in some capacity and using leverage as a way of managing that risk.
Interesting. Josh, is that something that you're seeing?
Yeah. I think Will brings up a really good point, which maybe is worth hammering home. The idea of these sort of very high leverage trading platforms in crypto probably came about, originally because of the fact that most exchanges in crypto act in a sort of a fully funded or pre-funded form, right? So, and Sam mentioned this earlier too, like if you want to buy crypto on Coinbase, you have to send them a wire first, or you have to send them cash first. And that really limits the velocity of trading activity in the space. And this is different than a lot of other asset classes where you can sort of trade the underlying asset without necessarily having fully funded your account. And this just goes back to kind of the origins of crypto as an asset class, and kind of how its market structure has evolved over time, and the fact that it's been mostly driven by retail trading platforms. So yeah, if you don't have the capital up front, or it takes too long to wire money back and forth, especially if you're international, it does make sense to sort of trade on these venues just to quickly get the exposure that you want. So I think that speaks to kind of the evolution of the asset class.
Cool.
Yeah, and that sort of capacity can be really helpful for firms that are more quantitative or like high frequency, for instance, where we'll often A, want to be able to put on a large position fast, and B, have no idea which direction it's going to be a priori. And if you're trying to, for instance, like trade spot, you might have to have both a ton of USD and a ton of Bitcoin on an exchange to be able to buy or sell quickly. Whereas with leveraged exchanges, you can just have a bunch of collateral which could collateralize either a long or a short position.
Got it. That makes sense from an efficiency standpoint. So interesting. I think, a lot of people, when they think about this topic of leverage trading, one of the things that immediately comes to mind is the Black Thursday events that happened in March, right? Where, the price of Bitcoin just absolutely crashes, and you had a number of firms who actually went out of business because of, various circumstances that happened on different exchanges. Does one of you guys want to take a stab at walking through the events of that day? Because I think it would probably be representative of some of the challenges in the space right now.
Sure, I can. So the gist of what happened, markets across industries, like for instance, the traditional financial markets like the S&P, were all crashing in the days leading up to this, and that included crypto. And what happened is there are a ton of, I'll use BitMEX as an example. There's a ton of open interest in their Bitcoin perpetual swap contracts. And so there's a ton of people who are levered like probably very high on average long. So as Bitcoin was plummeting, these people have to either post more collateral or their positions will just get liquidated. And when their liquidations happen, it's sort of similar to a market order selling in their market. And what this can do when it happens over and over again is it sort of creates a cascading liquidation effect where someone's levered long position will get liquidated. It will send a market sale into the order book, and then the price will go down, which will trigger more liquidations, and that will just keep on happening. And so this happened to a really extreme extent on March 12th or whatever day that was. And Bitcoin was just like plummeting and plummeting. It went below like 4K at one point on that platform. And it's actually, I'm not like trying to peddle conspiracy theories, but it's sort of unclear what would happen if they hadn't had downtime in the middle of this. And like there's a pretty real extent to which Bitcoin, at least Bitcoin as it's represented via their perpetual swaps, could have just gone to zero. And this is sort of a real effect that can always happen. It sort of happened today, actually, to a way lesser extent. Liquidations on BitMEX were actually what drove Bitcoin above 10K and back below it today. So this sort of effect is really, really often the principal cause of Bitcoin's price movements.
And does this happen in legacy markets, or like what about crypto makes? Is there something unique to crypto?
I mean, I think there's one unique aspect of the BitMEX sort of collateral model, which is that you can go long on leverage on Bitcoin using Bitcoin as collateral, and that's basically kind of wrong way risk on the collateral, right? So like if you're in a wrong if you're long positioned on Bitcoin, as your position marks against you, the value of your collateral that you've posted also decreases in value, which puts you at even more risk of getting liquidated. And so that move, especially in March, the one on the downside, that really plays a big effect. And in particular, right, if you're trying to bolster your collateral position on BitMEX, you're really relying on you have to rely on the network to be able to transmit your coins quickly, right? You need confirmations quickly so that BitMEX can recognize your collateral and prevent you from getting liquidated. And I think around that time, as the whole kind of crypto ecosystem was sort of melting down, like that was a major issue, that sort of network congestion, preventing people from retopping up their collateral. So I think a number of kind of factors played into that downside move, but I kind of agree with Sam is triggered by a lot of these cascading liquidations on BitMEX. Yeah, and actually, sorry, one more thing. The other thing that is sort of cool, like if you kind of see a lot of activity in the lending space, like you can get a sense for what collateral flows are like in the sort of broader market ecosystem. Like you can get a sense for who is borrowing a lot of money to post collateral against basis positions and things like that. Basis positions meaning like trading spot versus futures and sort of similar arb trades. And you can get a sense when like the market is certainly tightening up on one side or the other, whether it's the cash side, the US dollar side, or the Bitcoin side. And when you see like larger scale trends in the entire market where people are one-sided or another side, you can sort of get a sense for like when these liquidations are likely to happen and in which direction, because that's the kind of direction where the collateral is strained.
Got it. To your question, Spencer, on this versus traditional markets, I mean, I think traditional markets have a set of rules in terms of circuit breakers that they all adhere to. Markets, different exchanges adhere to the same sets of rules. Futures markets adhere to the same set of rules. And again, here, because you have this fragmented set of liquidity providers, they all have different rules. I thought Sam's point was interesting on, it was good that X went down in terms of giving it kind of its own circuit breaker, although not by design. On the flip side, that's happened, and these exchanges go offline, especially the ones that have high degrees of leverage, and then price moves a lot while they're offline, and then when they come back online, people are immediately liquidated because price has moved so much past their liquidation point, they're not able to post collateral. So I think the kind of nascent stage of the infrastructure and the fact that it's not resilient enough to withstand high periods of volatility, I guess in this case it's the mostly US guys, in other cases, it further exacerbates the volatility. And I think another thing that's important for people to understand is that with some of these exchanges, you are taking risk against the exchange, right? So BitMEX has a large insurance fund, Deribit has a large insurance fund. During this period, Deribit recapitalized their insurance fund twice because of losses that they were taking. And, luckily they have a lot of cash on hand and able to do that. But, that compared to, say, the CME, where it's essentially cleared that you're not taking risk against the CME, right? So that's a very different construct in crypto that doesn't exist for a reason in traditional markets, and that furthermore can kind of exacerbate these volatility.
Well, that's really interesting. Can you explain the insurance fund just for people who might not be super familiar with it? What exactly is it?
Sure. So, and it probably behaves a little bit different on each of these exchanges, but in short, I think a portion of the trading fees or commissions on each trade is being siphoned and put into an insurance fund, such that when there's these periods where the exchange themselves are taking losses, and they're taking losses because they're not able to liquidate an account fast enough. At least I think that's the most common occurrence when an exchange would take a loss, is that they're giving you leverage, and all of a sudden there's a really drastic move in price, and because they can't liquidate you out of the position fast enough, they themselves are actually taking some of that risk. And I think in the event where, so in those events, they're using insurance funds to basically kind of backstop those losses. And if the insurance fund gets depleted to zero, then I think most exchanges have a protocol whereby they're going to socialize those losses to people who have accounts on the exchange. So to prevent having socialized losses, Deribit again kind of recapitalized their own insurance fund, I want to say twice within a very short period of time around mid-March, to kind of instill confidence on the exchange itself. But it's a byproduct directly of how the exchanges offer leverage. And in cases of extreme volatility, the fact that they can't actually liquidate people enough or fast enough to prevent taking losses themselves. But you can defer to Stanford Josh. I'm missing something there on how I'm explaining it.
No, that was everything I would say.
And why can't they liquidate people fast enough?
That's a good question. I actually asked myself the exact same thing, because it clearly demonstrates kind of a flaw in their business models to some degree, or their infrastructure, that they offer leverage such that during certain periods of volatility, it's like there's a mismatch with the amount of risk that they're allowing people to take versus what their infrastructure can control. I mean, that's how I would simplify it. And maybe it's the simple answer is that it's so profitable over long periods of time that even though there's these bouts of extreme volatility, they're able to backstop it and still make sense to do. But, I'm not sure. I mean, the same thing happens to Coinbase. Like Coinbase went down just yesterday, when price was going up quickly. And it's kind of a running joke where it's a bullish sign of Coinbase is going down because there's people are trying to get on, the app or the exchange to buy Bitcoin. So, yeah, I mean, I'm the wrong person to ask.
No, I still think that's great color. Cool. So in like I think related topic, a lot of these venues are offshore, right? They're not in the United States. They're not regulated. And I think with that, you have a lot of uncertainty as an investor and someone who's using the venue. I mean, I was talking to someone who I think was an LP in a quant fund, and this manager basically said, yeah, I mean, we kind of account for at least one exchange going down and completely bust and losing all of our money on that exchange each year. And so I think for people who are new to this space, that just seems patently ridiculous, right? The fact that, each year you're going to lose all your money on an exchange and you're sending it offshore to some random place. Why is that the case? And is this a fixable problem, or are we just going to have to deal with this forever?
Well, so speaking from our vantage point, we only trade on U.S. regulated exchanges, and we only trade derivatives on the CME. So, and we're doing that exactly so we give investors assurances that we're not worried about an exchange blowing up as part of our risk mitigation policy. But that has a direct cost and a trade-off, right, with liquidity. So, for us, just the types of LPs that we're looking, that we want and that we want to attract, we don't think that we can make that trade-off. And so as a result, we're only trading, leverage positions on the CME. That said, CME volume is much smaller than, BitMEX and the number of exchanges. I think on the future side, it generally ranks kind of 7th or 8th in terms of total kind of futures volume and open interest. but eighth is much smaller, probably an order of magnitude versus number one. And then on the options piece, it's extremely low liquidity. So again, we're kind of making that trade-off for opportunity and volume versus risk. But again, that's just an active decision. And then I think why do people make the decision to trade those exchanges? Because there's a tremendous amount of opportunity. I mean, you'll see ridiculous cases in terms of the basis between futures and spot. You'll see funding rates that exceed, I think during that mid-March, it was like negative 1.5% per day, right? I mean, that's like those types of things just offer these amazing opportunities for traders and for firms. And so that's the allure of still taking that risk.
Yeah, I mean,
yeah, I can speak to the perspective where Alameda does trade on all of these exchanges, trading like a ton of volume every day, and the way we basically model each exchange as having some chance of defaulting based on their history and whatnot. So exchanges that have strong reputations at this point, we basically model as like very, very unlikely to default or result in loss of money. But in any case, our systems have a ton of safeguards in place against this. We have maximum capital limits on all of these exchanges, such that if some idiosyncratic event happened and we lost money on one of them, that risk is offset by the positive expectancy of doing trades there in the first place. Like Will mentioned, like these exchanges, while they carry some amount of risk, offer a ton of reward. As one example, just today, around 2,000 Bitcoins traded on BitMEX, like 10% cheap to every other exchange at the time. And the only way you can have access to that liquidity is by accepting like 2 BIP per day risk that they run off with the money. And from the perspective of a firm which is betting with its own money and with money that it borrows, that's just a very easy trade to decide to make.
Yeah, I mean, I would say looking forward to the future, right? Like there are a lot of changes going on in market structure now where you kind of hear these words thrown around a lot. And I think you sort of touched on this topic actually in your last panel with the infrastructure providers. Like people are starting to look at, prime brokers and custody providers in the space as a way of sort of allowing people to increase their capital efficiency. So like taking assets that are held in a custodian or, prime broker and using those as buying power on various exchanges without actually sending the funds to those exchanges. So that's sort of done in the back end by these sort of infrastructure providers partnering directly with exchanges and then sort of net settling like customer balances at the end of the day, things like that. So that is a positive development that I think in the long run, if it gets traction, it is a bit of a like chicken and egg, right? You need a lot of people to participate in a single provider to sort of make it worth it for an exchange to incorporate that type of business model. So I think the more that happens, the more you'll see a reduction of these sort of credit exposures that you have to exchanges, because people will be able to trade with assets that are held off exchange.
Got it. Cool. Well, we have to wrap in a couple minutes, so maybe we'll do one last question. So I'm curious for your guys' predictions just over the next couple of years. How does this space evolve or mature in what different ways? And I think I'll leave it at that. Who wants to start?
I'll start. Like, I think two things. The one I mentioned is just this idea of, a full service, I guess, platform for institutions to participate in the asset class. So that might involve this idea of a prime brokerage kind of platform where people can store assets and use it to access all different types of products in the asset class. Whether it's derivatives or spot trading or lending and borrowing, things like that. And the primary function of a prime broker is really to provide financing in the traditional world. So part of that is having a balance sheet and access to capital and things like that. And I think the second thing is the reason we're all on this panel is that I think we all think derivatives is going to be a much bigger part of the market. It already does sort of dwarf spot in crypto, but I think that's probably that trend is probably going to continue. A couple factors as well. Into the future.
Yeah, I think this will depend a lot on how U.S. regulation shakes out as well. Like for instance, on U.S. regulated exchanges, so like Will's mentioned, there's really not a ton of opportunities for leverage, and whether or not the U.S. decides to open that up and to what extent it does will have a lot of impact here. One other thing I'm expecting is for like Josh mentioned, I expect this space to keep growing, and I expect in particular for a lot of the problems that exist in the space to sort of become more and more solved as time goes on. So for instance, the weird cascading liquidation effect we see can be fixed, for instance, by having more just having greater liquidity all the time. And I think that's something we'll see. And so I basically expect that these products will get more liquid as well as way more efficient as some of these problems go away.
Yeah, I certainly second both of those comments. I mean, I think there's going to be a lot more firms, similar to like what Genesis is doing and offering kind of a full suite of solutions that are very akin to a prime broker. There's groups like Copper and Coiny, which are doing something similar. I think you're going to see a lot more technology providers are helping bridge liquidity across each of these, making easier to use, like proxy custody or collateralizing positions against assets like in cold storage. And I do very much believe that actually CME volumes and regulated venues will continue to increase relative to unregulated exchanges, as boring as that sounds. I just think that with more institutionalization of the space and the likes of everyone's been talking about, Shooter entering and Renaissance entering, like most of those players are going to, predominantly trade on regulated venues. They might have partner capital or something else that will trade offshore. But if you're, acting as a fiduciary for, investor capital, you're going to be limited to these regulated exchanges. So I very much think that you'll continue to see CME volume increase. And I think with that, start seeing volume increase further out the curve, which will then enable derivatives that are longer dated, to get more liquidity. So I think we're already on a pretty clear path there that we're only going to see, further extend, this year and beyond. And then to the panel that was 2 or 3 before with Kyle and Lhasa, I do think a lot of these like decentralized applications providing liquidity will come, but I think it's a very different. I think it's multiple years out and really kind of a different application than just speculative trading or hedging. So.
Yeah, it does seem like there's some regulatory arbitrage at play there, especially with like retail traders in the United States, right? But cool. This has been really awesome. The color and commentary has been really helpful. So we unfortunately have to wrap, but thanks a lot for joining, and see everyone else soon.
Yeah, thank you.
Thank you.
See you guys.